Welcome to Wall Street Week, the show of record for long-term investing. I'm Anthony Scaramucci.
And I'm Maria Bartiromo. Gary Kaminsky will be back next week. Forget Dow 19,000. Are we headed for Dow 20,000 in a year? At least one analyst at S&P Dow Jones Indices says yes. But is he right? And if he's right, how do we get there?
We turn now to a giant of finance to weigh in. Bill Miller is the chairman and chief investment officer of LMM. We should note that just this past week, Bill and Legg Mason announced that Bill will acquire all of Legg Mason's interest in LMM. Bill, along with companies he controls, will own 100% of LMM. Bill, welcome to the show.
Thanks, Anthony.
And I want to talk right away about the macro economy. Why don't you tell us a little bit about what you're seeing for the U.S. economy and stocks in general?
Well, the U.S. economy has been broadly on an upward path since the financial crisis. I think we saw a payroll number last week that was very strong, but when people were trying to look at it through the lens, they pointed out that, well, payroll and unemployment, those are lagging indicators. But conveniently forgetting that the leading indicators, credit spreads and stocks, are doing great. So I think the outlook for the U.S. economy is solid. It's among the best in the world. We have low inflation. We have low unemployment. We have record corporate profits, record GDP, record household net worth, and stock prices are, I think, stupidly cheap compared to bonds.
The Obama administration is in the news now. We're litigating whether or not their policies have been successful in aiding the economy. Some of the detractors are saying that the middle class and the lower middle class have had stagnating wages. What is your report card for the Obama economy?
Well, you can look at that in many different ways. At a very macro level, when the administration came in, we'd had the worst financial crisis in history and the worst recession since the Great Depression. And then 8 years later, we have, as I mentioned, record profits, low unemployment, low inflation. So if you look at it just that way, it's like it would be considered a marvelous record. On the other hand, as you point out, a large portion of the population has not benefited from that. And I think one of the issues that would be very helpful in this election and future elections, if people got away from, I'd say, those macro things like GDP growth and corporate profits growth and focused on the growth of the median wage in real terms. And if they made that their objective, that the average person would do better, I think it would give us a better way to evaluate the success of those administrations.
I'd like to follow up on your macro story. But first, Bill, you've got to tell us about the news of the week. Bill Miller leaving Legg Mason after 35 years. People want to know what this means, how it's going to change your business. Why the move?
Well, technically, I haven't been a Legg Mason employee for a couple of years. They merged the subsidiary that I ran, LMCM, into ClearBridge as part of a broader strategy to have fewer managers and bigger platforms and try and get various things like the equity businesses consolidated. So when that happened, I had the only subsidiary that wasn't 100% owned or controlled by Legg Mason, LMM, and so I took that out of Legg Mason, but they still retained an ownership interest in it. And it had been a publicly stated goal of Joe Sullivan, the CEO, to basically clean up some of those loose ends, and so this really represents that.
So when you look at the markets today, I'm struck by what you just said. You said that the market is cheap. Now, we've seen a pretty good rally, right, in stock prices. You still see value. And
when you say cheap, you mean cheap relative to interest rates or just cheap overall?
Well, there's a couple things. The market has, like many markets, there are parts of it that are expensive and parts of it are cheap. And so to talk about the market as a whole, you're amalgamating all those things. So, for example, I happen to believe that utilities, consumer staples, telecom are ridiculously overpriced and very expensive because they're bond proxies and they've been a safe place to be. Whereas more cyclical names, more controversial names, more perceived risky names are very, very cheap. So you've got this bifurcated market. But more broadly, you know, if you think about the old Fed model that Alan Greenspan used to talk about, where you'd look at the return or the yield on the 10-year Treasury and compare it to the earnings yield on the market. Well, and it was thought that, well, if the 10-year Treasury was higher than the earnings yield, then stocks were cheap, and if it was lower, stocks were expensive. Well, right now, the 10-year Treasury yields 1.5%, and the median multiple on the S&P 500 is about 16 times. So call it, a 6% earnings yield on the market, or 16 times earnings on the market, and let's call it close to 70 times earnings on bonds. And I think that's a spread that is very, very wide historically, and one that I think will be resolved in favor of equities.
Okay, so for our viewers who are not great at math, what you basically just did is you took the reciprocal of those two, just so that you can make a comparison in terms of what the future cash flows were.
I'll make it even easier. The dividend yield on the S&P 500 is now considerably higher than the return you get on a 10-year Treasury.
On Unbelievable.
The 10-year Treasury doesn't grow.
But
right?
historically,
dividend yield will grow 5 to 7%.
That's a great
just
point.
to further that argument,
Yeah.
historically, when that happens, typically, Bill, you get a rise in stocks.
Or a decline in bonds, yes, or both.
All right,
yes.
there you go.
So, you know, nobody expected telecoms and utilities to be the leadership of this market this year, but that is exactly what has led this market.
Yeah, and we're seeing also very lax monetary policy. And so do you think that there's a likelihood, if possible, that there'll be negative rates in the United States?
I don't see that. I think the U.S. economic growth is it's slower than history, obviously, but it's not so slow that we would see negative rates. You'd have to have a very bad situation, probably starting outside the U.S. and factoring in over here for that to happen.
We're just getting started. Bill Miller, stay with us. A lot to come. Wall Street Week. We'll be right back.